recent results, they talk of heavy oversubscription to these auctions, right? So then if there is a heavy oversubscription, then obviously interest rates should come down as well. So the market seems highly liquid these days. So that also is one of the reasons. But rest of the macro factors, if you look at, may not necessarily push interest rates towards a single digit as we see it, because we are still coming out of this economic, debacle. So therefore, there is that concern. Then on the other hand, if you look at FX rates, at the moment, the forex rates also, if you look at it, rupee has been strengthening from around 330 levels at the worst case, which we saw about a year ago or year and few months back, to today, which is around 310 if you take a middle rate. Now here, again, do you think that it's the most efficient price discovery, or do you think that this is the most efficient exchange rate, or do you still think that there is some influence? What do you think?
There's big influence there because we have curtailed imports a lot.
Yes. We have curtailed imports a lot. Now that is basically, it's a trade decision, right? But given the current trade structure in the country, right? What do you think? Because, see, trade is a decision outside of forex. Because what we basically say is forex is a function of demand and supply for dollars. So curtailing demand through trade is outside the realm of this discussion, right? Given the current demand and supply, do you think there is manipulation, or do you think there is influencing? What do you think?
The loan repayments are also not going except the bilateral payments. So the money is forex is not like going out of the country as it is supposed to be usually on general terms. Right.
Yes, correct. Very good. So trade. Yeah, go ahead. Yes. Exactly. Very good. Yeah. So that's where it is. So there is a certain amount of intervention in the market in terms of creation of demand from the central bank to boost up their reserves, which basically which has basically enabled the rupee to appreciate, right? But now that is for reserve purposes. This is how basically, if at all, if there is an intervention in the market, this is how it should happen in my mind, right? But in the past, there were times in the Sri Lankan market where regulators or central banks would come and basically say, okay, you can't go beyond this rate, or you can't go above this rate. They would basically define, or there would be kind of moral suasion, right? Those guys would come to the market and say, okay, no, you can't go beyond this. This is the rate at which we would like to have the dollar. There was a time like that, right? And then it basically we all know what happened later on. So that's the end result. When there is inefficiency in that manner, directed kind of pricing, it because then what actually happens is there is demand and supply in the market, but it doesn't get reflected in pricing. But currently, what reflects in the pricing is due to various aspects. You have uh, curtailed the demand and supply, and what is getting reflected at the moment is the price for the existing demand and supply. So there is a certain demand from central bank to boost up, because they are also doing it not because there could be two reasons. Now I can't read their minds, but there are two visible reasons that they could be buying dollars for. One is we really had a reserve issue, right? So therefore, when there is ability, they can basically buy reserves, right? Or boost up reserves. The other thing is, they also have a role to play in terms of smoothing this appreciation, because they need to basically boost up exports now. So therefore, for that purpose also, they may want to deliberately keep the rupee from appreciating any further. Now, I do not know what the real reason is, but however, as you said, if that demand creation from the central bank is taken out, then rupee going by the normal commercial needs, the rupee should appreciate a little bit more, little or much more. I don't know. Maybe it should come to the 290s or whatever, right? Uh, so that's what this price discovery is all about. But if you go to some other G10 currencies, the freely convertible currencies and all, their prices are determined through sheer market demand and supply. Central banks hardly get involved in the currency manipulation. However, there is a recent, trend, or should I say, there are news items coming out recently in the international market for one particular country threatening to intervene in the market. What is this country? Where have you seen one country retain currency? Hmm? Where have you seen this?
India.
No. Let me try to get that. It is basically the dollar is strengthening and it is hurting that economy. And it used to happen even in the good old days, and they used to come to the market heavily. And they were a known entity who basically comes into the market. This is Japan, right? Now, these days, Japan was basically, we used to see Japan coming to the market heavily in the good old days. I'm talking late 90s, that period. But I think there was a huge battle between US and Japan on this, and Japan was, kind of advised Bank of Japan not to get involved in the currency manipulation, because they were using their currency manipulation to, promote exports, the Japanese yen. But however, after certain, free trade, WTO formation and things like that, they were basically disciplined in a way. However, and they were basically, they went out of the market. And the Japanese yen started trading according to the market demand and supply. But since of late, we have seen that with the strengthening of the dollar, Japanese yen is getting weaker. It is trading above 150 also at times. Usually, these days, it's trading around 140, 145 levels to the dollar. But now I think it has gone to around 150. And what Bank of Japan says is it is not very desirable for them to operate at that here. This is what this is how they have basically. That is a news article. Let me show it to you. Can you see? Can you see this?
Yes, sir, we can.
Yeah. So they are basically what I'm talking about is the let me, oh, sorry. Sorry. No, because these are important. That's why I want to basically show this to you all. This is how they basically come to the market nowadays and try to influence the direction, since they are not able to come directly and intervene in the markets. So the finance minister of Japan has basically come and looked at the market and said that he won't directly comment on forex levels, but important for currencies to move in a stable manner, reflecting fundamentals. So they are basically giving certain indications to the market that if you don't behave well or if there is too much volatility, then we may, come in, kind of thing, because they are setting the stage for intervention, right? So when the currencies are too volatile, the central banks have not a right, but they have a kind of a purpose to make sure that the forex markets are stabilized, the volatility is brought down, so therefore they can basically take certain actions to cool down the markets. So that's why he comes and says stable moves of FX is desirable, and so on and so forth. So must respect the independence. I mean, these are some excerpts that somebody had taken out from a press conference that the finance minister has had on Friday. Because if you look at the market rates have basically shifted drastically against. So if you look at this here, you will see Japanese yen trading at 150.27 in the morning on Friday, and evening also it was around 150.29, right? So, so in such situations, they have the ability to come and stabilize the markets. But other than that, they will not, intervene in the markets and just allow the markets to operate based on their demand and supply. And that's why we basically say that forex markets are the most efficient markets as far as price discovery is The other thing is very few people would be able to influence the market because the market itself is quite large. We talked that the other day. It's around 6 to 7 trillion, 6 to 7 trillion US dollars per day. The volume is around. I mean, it's so huge. The entire forex market. If you take individual currency pairs, of course, it will be less. But however, they are running into hundreds of billions of dollars. And it's extremely difficult for anybody, any individual person to influence markets like that. But there had been instances in the past. What is the most daring example of one individual basically taking on markets? Who is this person? Have you heard of this person?
George Soros in East Asian financial crisis.
Prior to that, he took on the
Latin American markets.
No, the Bank of England.
Okay. Yes. You told us.
Yeah.
So yes, sir.
Yes.
Yeah.
So, I mean, there is an interesting clip on YouTube. If you look at how he basically managed it, how he did that. And also there are interesting YouTube clips on, how banks have basically capitalized in the past. I mean, we are talking, 1800s, even during those periods. Families like, prominent banking families like the Rothschilds in Europe, when they originally started in Europe, how they basically benefited from speculation. So likewise, George Soros basically took a bet on sterling pound initially, and the story goes that he made $1 billion in 24 hours. Later on, he took on certain currencies, Asian currencies as well during that period. So other than that, it's very difficult for single entities to shift markets, right? Maybe they are able to for a short period of time, but not for too long. So that's why even the governments, country treasuries don't try to intervene in these markets, right? And small it may be, Sri Lanka, we learned the lesson. We lost about how much? About $3-4 billion year before last in trying to maintain, because at that time some of these senior officials thought that governments are bigger than the markets. Small it may be, the local market may be a small entity, but still they learned a bitter lesson, because afterwards what happened was the markets took it in the opposite direction. We lost I don't know how much they claim to have spent on trying to defend the rupee. I mean, I'm talking early 2022 kind of period. And then eventually they had to give it up because they were running the reserves down, made the country reserves negative kind of. And then end of the day, the markets took the rate in the opposite direction as well. So finally we had no, leg to stand on. That kind of thing. And a bere palvakut nahi, gahapu padekut nahi kind of thing, right? So that's why it's very important. Why I basically say all these things is interest rates and exchange rates are extremely sensitive indicators. They are extremely sensitive tools. And if anybody misuses these tools, it will have drastic implications on the macroeconomy. So we are basically going through such mismanagement in the recent past, and as a result, the people of this country, more than anybody, are basically going through untold suffering, right? So that's why it's important for us to understand these concepts very well. So Forex basically allows you therefore to buy and sell or exchange one unit against the other for investment purposes or trade purposes, or even thirdly, as a commodity by itself, right? There is a speculative value, therefore. You buy and sell currency to make money, not necessarily to make an investment in US dollars or any other currency versus a local currency, or to buy and sell goods. So those are three different purposes. Do you understand those three different purposes which currency is used for? Right? You can basically use foreign exchange to engage in international trade, buy and sell goods or services. Then you can basically use foreign exchange to engage in investment purposes, like say a Sri Lankan wants to invest in US dollar, US treasuries or whatever. Then you basically first you have to go through the forex route and convert your rupees into dollars, and then using those dollars you go and invest in a US treasury bill or whatever, right? So vice versa, reverse happens when US folks come to a country for, let's say, portfolio investments in Sri Lanka. They want to buy Sri Lanka treasury bills or whatever. Then they will basically do the reverse. In addition to that, the third element is currencies are converted and reconverted to generate profit or generate an income, right? That is for trading purposes. Now, all three elements basically create demand and supply. Do you agree with that? Even speculative trading creates demand and supply. Now, what do you think about these three? I mean, of these three, are they equally beneficial to the market or not? Any thoughts on that? You don't understand my question?
So speculative could be detrimental sometimes, because
Yes.
like what happened with this George Soros and Bank of England.
Yes.
Yeah.
But then, what are the benefits of speculation? Do you see any about speculation?
I guess
There is a particular term that you use.
as in a benefit.
Yeah, as in a benefit. I'm leading you towards getting me an answer from you.
Okay.
Say, let's move our attention to share market, for instance. In the share market, you have the investors who are basically fundamental investors, right? Who basically read through the fundamentals of companies and invest. Then there are day traders who are basically speculators.
Yeah.
Right, short. Now, these short-term investors, what do they provide to the market?
Price discovery?
No. Liquidity. See, they bring in volume. Transaction volume is increased because of these speculative trades. No? See, if there is no speculative trading, there is a certain portion of demand and supply which goes away. When I say certain portion, a certain value is not basically traded in the market. Like say, for instance, daily turnover or daily volume of trades, not dollar value or rupee value of trades, let's say is 100 million, right? Then you have, let's say, 500,000 transactions happening, kind of, right? So both these things can basically contribute towards the volume in the market, the number of transactions and the dollar value or the rupee value of those transactions. If you take the speculative trading out, there is a certain element which goes out. There is a certain number of transactions which go out and a certain portion of dollar value which goes out of the market. Then the market becomes somewhat restrictive, right? They become illiquid in a sense. Because, like, say, for instance, if a trader, if an investor wants to buy a particular share A, right, for investment purposes, he has to basically find, if these speculative traders are not there, he has to basically find that share from a counterparty who wants to sell. From an investment point of view, he is not very happy with the way this thing is run, what the company is run. Therefore, he has to sell. Now, if you find that kind of a seller only, this investor can basically buy that share. But when there are speculators who not necessarily look at the company profiles, but the price movement or the price volatility, they basically their decisions to buy or sell depends on their perception of price movement. Situations, there could be sellers who want to basically sell for price movement per se, and these investors who want to buy for long-term investment purposes can basically pick up those shares, right? So these speculators, therefore, is not unhealthy. It's healthy to a certain degree. They also bring in certain amount of volatility, right? Similarly, in forex markets also, the speculators bring in liquidity into the market and transaction volumes. Because if not for them, you might not see equal amount of sellers and buyers. And in such illiquid markets, price movements could be quite drastic. When the market is highly liquid and then the transaction volumes are quite large, the volatility, the magnitude of volatility becomes lower. Otherwise, the volatility, the price movement could be quite drastic when there is an illiquid market. You understand? Because the volume of transactions get curtailed, or the value of the transactions also get curtailed, and therefore from one transaction to the other, the price movement could be quite drastic. And that is what we saw in the forex markets when the forex markets became very illiquid, right? From one transaction to the next, the price movement was quite drastic. So therefore, there is a important role the speculators basically bring to a trading market. But however, if there is too much speculation, then it is also not very healthy, especially in a share market kind of environment. From a macro point, institutional investors come to markets when the markets are liquid for one, and when there is fundamental trading available in the market, because that also is reflective of price discovery in a sense, because fundamentals in that case determine what the share price should be. But then around that fundamental price, there will be a certain speculative volatility, together with which give you the discovered price in a way, right? So that's why speculative traders are they are doing a certain service to the markets. But what is detrimental to a market is manipulative players, right? So the next level of speculation is manipulation. Then what they do is, now speculators just speculate on, there is a guesswork going on. It might go up, it might go down, kind of, right? But in a manipulator, when a manipulator comes into a market, through speculation, he basically takes it to a different level and in a particular direction. That's what a manipulator does. So we need to basically differentiate between general day traders, speculative traders versus manipulators, right? And what needn't be, which is extremely detrimental, is a manipulator. These pump and dump kind of traders that we saw in Colombo share market, those are manipulators. Then insider traders and front runners, and I mean there are so many such people who are detrimental to a market. Free price discovery, which is detrimental to free price discovery. Okay, agree with me?
Yes.
Yes.
Yeah. Yeah, go ahead, please.
So buying and selling, you mean buying and selling of goods, forex markets can be used for. What is meant by exchange and trade settlement?
Trade settlement is basically like when you buy and sell goods, you settle trade transactions. You bring in oil and then you settle for oil bills, right? So settling these trades, the transaction may happen today, but if you have a settlement happening somewhere, then somewhere in the future you will basically create some demand on that particular date, not only not necessarily on the date the transaction happens, right? So for trade settlement there could be. Then loan settlements. If a country has to basically pay some foreign party a loan payment, then on that particular day, the day on which the settlement happens, there could be activity in the market where there'll be a sizable demand for that particular currency, right? Then if you are basically buying for travel purposes, if you want exchange, right, foreign currency, foreign exchange, then that will basically create some demand for foreign currency. If you basically sell those currencies in the market after you basically come back, or when foreigners come in to Sri Lanka and then exchange to rupees, that will basically create the supply side, right? So these are the various different ways through which, and also you may basically exchange from one currency to another. You may basically, like say, how should I explain that? Like say in a swap transaction, you basically exchange your dollars to rupees and buy back in different time periods in a currency swap, right? You sell today and buy in the forward market. Now that also basically creates demand and supply in different time horizons, right? So for all these transactions, Forex basically provides that exchange medium. Agree? Did I answer your question?
Yes, sir. Thank you.
it also trades in pairs. Forex, that it basically gets transacted in pairs. When you sell dollars, you buy something else, rupees, or when you buy dollars, you sell euro. So it's basically, therefore, price is always quoted in FX against a pair of, it relates to a currency pair, right? Then price determination in certain, mostly it's free float, right? That's basically demand and supply driven only. But in addition to that, there is in free float situation, there is no central government or central bank intervention or any influence. But there are certain countries like ours where there is a certain managed float, right? Even though, like in Japan, we call it a free floating market, but as you saw, there is a certain kind of influence which the Treasury or Ministry of Finance can exert. So in such cases, people basically put a question saying, is it free float? But the answer is that yes, it is still, because compared to the influence that they are making, the market itself is so huge, so that it operates. The free price discovery is much larger than the influence that comes in. There is a impact from time to time, but by and large, those are free floating markets. Then there is a third type of exchange determination or exchange system, which is completely pegged or fixed, right? Like some of the Middle Eastern currencies are pegged, like the Saudi Riyal and things like that. Okay. Then it trades 24 hours. It doesn't, there is no, some market is open somewhere, and most of these markets are interlinked. So even if you have a night desk in Sri Lanka, right, you can basically trade 24 hours because there is some market open somewhere, and there are electronic ways through which you link up with these markets, right? So therefore, a trader sitting in Sri Lanka can trade dollar yen when the US markets are open and when the Japanese markets are open as well, right? So therefore, a treasury, if sufficiently resourced, treasury in the sense a dealing room, if sufficiently resourced, can have a forex desk which basically operates 24 hours a day, right? And then sometimes it's 7 days a week also, because some markets operate, like the Middle Eastern markets have a different weekend to that of others, right? So there is a Sunday desk also which is happening, but Sundays is the least active day. Usually it's Monday to Friday.
So, practically, how are these traded? Are there exchanges like the stock exchange in New York Stock Exchange?
Yeah, that's what I was basically coming to. See, there are no exchanges or clearing houses, right? For Forex, there is no stock exchange equivalent. We call such markets over the counter, right? OTC traded. The next point I put is OTC traded. What is an OTC trade and exchange trade? What is the difference between the two? Now, in a share market, when you buy and sell shares, do you know from whom you bought, or do you know from to whom you sold your shares?
No, you don't know that.
No. You don't know the counterparty, because the transaction is going through a exchange, stock exchange. Your broker will basically buy from you. It goes into the intermediary account, and then from there it basically goes to a buyer. And the exchange, the stock exchange, does the exchange from the buyer to the seller. But in a forex transaction, when it happens, in practice, how it happens is a trader in one bank will directly deal with a trader in another bank. Those two traders can be facilitated through an intermediary, like a forex broker. But eventually, when it settles the transaction, or when it's concluded, it is concluded between two entities, a selling entity and a buying entity. So the buyer knows who the seller is, the seller knows from whom he is buying from. Right? So these are the trades which are basically called over the counter. Over the counter means over the counter of my bank, and the other party also is basically trading over the counter of his bank. Right? So whenever you see this term over the counter traded, what it means is that the trades are happening between two counters. Counter means the trading desk equivalent. Right? The trading desk of, let's say, Bank A is basically dealing with the trading desk of Bank B. Then the transaction is concluded over the two desks or the two counters of the two banks. That's why they are over the counters. When you talk of derivatives, for instance, there are certain complex derivatives, or even in Sri Lanka, of course, I mean, we don't have much derivatives, but even the simplest derivative, which is a FX option or an interest rate swap, would be traded as over the counter in Sri Lanka. Right? And we would know with whom we are transacting, and so on and so forth. But in developed markets, there are currency derivatives, there are interest rate derivatives, there are commodity derivatives. Those derivatives, these are standard derivatives. And they are basically exchange traded as well. Some are exchange traded, some are over-the-counter traded. Right? So how it happens is, now say suppose the trader, FX trader in Bank A wants to buy $100,000. Intermediary called the intermediation happens either through a physical or a
Recording in
over-the-counter
progress.
transactions, you need to have what you call exposure limits of the counterparty. So therefore, there is a certain way in which you basically verify. But even in a broker situation, you will ask the broker. Initially, the broker will not show you the counterparty's name, but only the price. And usually these brokers in markets like Sri Lanka, they know who can deal with whom, right? and they will show the best buy and the sell price to a bank who can dealable prices, we call them, right? And then once the transaction is agreed upon, they will show who the counterparties are, and then will basically exchange the funds. That's how trading happens in the local market, and even in the foreign markets, it's mostly through Reuters, and settlement happens that way. So over the counters of two banks. Okay. Then these FX, there are certain special terminology that you use. We have cash transactions, TOM transactions, spot transactions, forwards, and swaps. These are the most common, right? What is a cash transaction? Now, in a Forex transaction, there is a peculiarity. I mean, it's not necessarily a peculiarity. Even in a transaction where you buy and sell, or you buy a car, let's say. Now, if you buy the car today and pay cash today itself, you basically bring hard currency cash bundles and give it to the person today itself. So the transaction happens today. The transaction day is today, and cash settlement also happens today, right? So then that is similar to a cash transaction. If your transaction happens today, but you give money to settle tomorrow, so you give a check, and the check gets cleared tomorrow, then such a transaction is called a TOM transaction. If you do the transaction today and the cash settlement happens 2 days after, not tomorrow, day after, right? Such a transaction is called a spot transaction. What we see in Forex is mostly spot transactions. Then anything beyond 2 days, if the settlement happens anything beyond 2 days, then such transactions are called forwards. And swaps are transactions where you buy and sell at the same time, but the settlements happen on different dates. Now, I will be basically talking about swaps separately, so I will not go into detail. So in an FX transaction, also like in a car transaction, where you bought and sold, or you sold a car or bought a car, in FX transactions, what there is a commodity, then there is a if I'm basically buying, let's say US dollars, then my bought or my buying or plus US dollars is equivalent to minus rupees. So what happens is I give out rupees and get dollars, right? I'm like in a car transaction, I give out the car and basically get rupees. Here, both the commodities are currencies, right? So in such situation, I can agree on a transaction and say, okay, I want to buy $1 million from you at this particular rate, right? 312. Now that agreement is the conclusion of the transaction. But the actual conclusion of the trade happens when the settlement happens, right? In this case, the settlement is I give up 312 million rupees, or I transfer 312 million rupees to the counterpart, and the counterpart simultaneously gives me $1 million, right? Now that if that exchange of funds also happen today, as similar to the transaction date, then such transaction is called a cash transaction. If the transaction is done today, agreed on the rate and concluded the transaction today, but the exchange of funds happen tomorrow, which we call settlement of funds, then such is a tom trade. Then if settlement of funds happen 2 days hence, then such is called a spot trade, and anything beyond is a forward. Okay. So these are conventions. Now, spot transactions are the most common because in the good old days, when when technology was not so developed, to ensure that funds are basically in a now, where do they settle? That's the other question, right? Now, I will receive my dollars into now in banks also, they maintain different banking accounts. Like for different currencies, maintain different accounts, which we call correspondent banking accounts. So like a local bank A, let's say, will if he wants to basically trade in different currencies, he will have to open accounts in different currencies, right? The settlement accounts. So those things will be maintained in different banks. Like a US dollar account will be held in a US bank. Euro account will be held in a European bank, and so on. Japanese yen account will be held in a Japanese bank, and so on and so forth. Right? So then, and the rupee account of all the commercial banks are held with the central bank. Right? So if I'm basically selling rupees and receiving dollars, I will receive it into my US dollar account held with a US bank, and I will pay the rupees from the rupee account that I have at the central bank. Right? So in the good old days, for me to ensure, because the set rupee side will go immediately and I will have proof. And it will basically go to the party the same day. The counterparty also, it will go to that counterparty on the same day to his central bank account. But I will basically see the dollars coming only the following day. Right? So therefore, to ensure that, and also then in the good old days, we had to basically send telexes only during the time when that market was operating, right? And so on and so forth. So we needed basically time to do this settlement process, right? So therefore, we needed at least 2 days to basically get this settlement process done. And therefore, spot was basically considered the most effective date on which transactions to settle. So today you agree on the transaction, but the settlement happens only 2 days hence, during which time you basically do the transfers and things like that. Okay. But today, with this day and age, funds transfers are instantaneous. With the technology development, it is not a necessity that spot is the most common. But still, for traditional purposes, spot has become the main transaction settlement cycle even today. When we talk of rates, what we talk of is spot rate. Okay. Then go ahead, please. Yeah. 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 Yes. Yeah. Yeah, yeah. So that's also true. But ideally, to this, yeah, there was a huge discussion earlier. This share settlement was happening on a T+7 basis, right? When I was handling custodial services in a bank here many years ago when I was a junior. At that time, when share trading was introduced in Sri Lanka for foreigners, when they opened share markets to the foreigners, the settlement was happening on a T+7 basis. So it basically gave the buyers a huge advantage because they had to basically bring in the funds only 7 days after trade is concluded. Now, I believe that was done to popularize it amongst foreigners because foreigners because they were net buyers at that time. And it was a kind of benefit to them as well. But ideally speaking, that benefit should not be there. If you give up your shares today, you should basically get the settlement today itself. Am I right? Now, share market, it's different because you are giving up shares today and you are getting funds in 7 days. In a forex situation, it's slightly different. See, this T+1 and T+7 and T+0, the shares move on a different cycle and cash move on a different cycle. Am I right? In forex markets, it's basically agreeing to exchange or concluding a transaction and simultaneously exchanging funds. So the difference is between agreeing on the transaction and exchanging funds. So nobody basically gets a benefit against the other in terms of funds. It's different to the share market. Understood? Yeah. So then there are things like in forex markets, forex like any other index, like in the share market we have the SPI and such indices. In forex markets also we have, especially for US dollar, there is a index. That is the most commonly used because US dollar being the world currency at the moment. There are many features in the dollar market, and one is the availability of an index that's called DXY, DXY, dollar index. It basically gives you the relative strength of the dollar against a basket of currencies, right? If you go to that newsletter that I showed you previously, yeah. You see where my cursor is, DXY. Do you see this?
Yes.
Yeah, so that's basically there is no currency called DXY. It's the dollar index. So it basically, I have seen it moving around early 90s or like say Dixie around 90s. Now Dixie is around 104. So 104 shows a fairly strong currency. Okay. Strong dollar rather. Yeah, so going back to, so that's the dollar index. So if you follow the dollar index also, you will realize, like say when the dollar is getting oversold, the DXY or the dollar index Dixie basically comes to below 100. and if the dollar is stronger in the international market, the DXY is higher than 100. Yeah. That's basically some features of the market. Now we'll basically, and I mean, these again I have talked about. So this is just for the completion of the discussion. These are slides that you can refer to. So why Forex is because mostly, we don't have we were talking about, if John Maynard Keynes won that battle in Bretton Woods, we would have basically seen a global currency coming in the form of Banco. But we don't have that kind of a thing. We have US dollar as the main global strong currency, and euro and others as well. But individuals have their own currencies. So therefore, it needs to get exchanged somehow. Even if there was a currency called Banco, we would have basically had to, because domestic unit would not have been Banco. If it was, then fine. Otherwise, we would have had to basically convert our rupees or the domestic unit into that international independent unit. So therefore, Forex needs to happen when we are basically dealing across borders. Right? Now, origination of Forex perhaps would come from the fact that each countries would have, like, say, for instance, remember when we were talking about, bimetallism, gold standard, and so forth, we were basically saying US dollar had a certain amount of one US dollar or US dollar, one USD coin had a certain amount of gold in their currency versus, the Deutsche Mark or sterling pound would have had a certain amount of, 7 grams in their currency unit, whereas US dollar had only 1.05 or some grams of gold in their unit and so forth, right? Now, this basically gives rise to the, exchange ratio, right? But if you basically take a step back, it could also reflect the price structure of a country, right? We all know that a haircut in Sri Lanka, I don't know how much it is, 700 rupees. Since I don't use that service, I don't know how much a haircut is. But let's say it's 750 rupees. But if you go to, say, for instance, have a haircut in New Zealand, it'll be $10 perhaps. $10 is about 2,500 rupees. So the same haircut has different price levels. Similarly, a house in Sri Lanka, let's say, I'm talking middle class, would be, let's say, for 35 million, 40 million rupees. But if you go to buy a middle class house in New Zealand, it will be easily about 200 million, 250 million, $1 million New Zealand currency, right? So there are different price structures in different economies. And therefore, the currencies will reflect certain the differences in these price structures. And this is how basically purchasing power parity develops later on. So if you take a haircut as your unit, Sri Lanka basically spends, if the price is basically converted to Sri Lanka rupees, the haircut in Sri Lanka is 750 rupees, which is basically 2,500 in New Zealand. Therefore, there is that particular ratio between the two currencies as well. So that's how this, exchange rates kind of, you can basically relate. You can, if you go deep into that concept, this is how exchange rate would come about because the currencies will have different values between the two jurisdictions depending on their price structures. Okay, but later on, it will also get influenced by the relative strength of the economies, the stability of the economy, the productive capacity of the economies, and so on and so forth. So all these things basically contribute towards the value of a currency, right? And then, depending on the differences between the two economies, the currencies will have different values, right? Then, what is a foreign exchange market? It basically comprises of, we discussed about some of those when I was answering that question. There are commercial banks who are buying banks and selling banks. Then there are brokers, electronic platforms, which we talked about. Then you have regulators like central bank, right? And then there are banks are buying and selling. They could buy and sell for speculative purposes, or they could basically buy and sell for their customer transaction purposes, right? For trading purposes, for travel purposes, or services purposes, or investment purposes. Now, so the customers could be importers, exporters, investors, traders, travelers, professionals who basically get professional fees from overseas, right? Then cross-border service providers, again, they are customers, right? Travel agents or whoever, or IT specialists and things like that, or money changers. They are also part of this market. Then we have the informal market, or we call it either informal or illegal market, which is the undials and the hawalas. They are also part of this because they, as I told you, contribute to the demand supply equation, right? And we said it's about 7 trillion, the total volume. And this is where I basically said it's a 24-hour. So this particular chart basically shows you that there is some market somewhere in the world open during a 24-hour period. And this is that explanation on Tom, Spot, and Cash, right? Okay, the difference between appreciation, depreciation, revaluation, and devaluation, right? When the market forces take the currency up and down, it's basically appreciation or depreciation. If there is a targeted, value enhancement or value reduction in currencies, such as revaluations and devaluations. Appreciation and depreciation happens in which kind of? I was talking about 3 types of, free float, managed float, and fixed exchange rate regimes. Where would revaluation and devaluation happen? Most commonly? Do you know the difference between revaluation and devaluation? Oh, sorry. Appreciation, depreciation, and revaluation, devaluation?
Foreign exchange appreciation and depreciation, we have some ideas, but this re-evaluation part, I'm not quite sure.
Okay. Yeah. So I'll explain appreciation, depreciation also. See, if the market forces are basically moving the currency up and down, like what is also happening in the Sri Lankan market to a certain extent, because it's the demand and supply which is taking it up or down. in financial literature, now we basically say the rupee is appreciating, right? So similarly, in the international financial literature, if you look at the news items, they will be talking about appreciation and depreciation of currency is improving or value is coming down due to market forces. But revaluation and devaluation happens mostly when it is a fixed exchange rate regime, right? When see, in a fixed exchange rate regime, what happens is, I mean, we will be going through some of those. The conversion rate, like say for instance, 4 Saudi riyals and 75 cents or whatever is equivalent to $1. That is fixed, and that's the rate at which Saudi riyals get converted to US dollars. Now that exchange rate is determined based on the relative strengths and weaknesses of the two economies. So the two central banks would basically engage in certain discussion and decide, okay, this is the best reflection of the exchange, the two economies' strengths and weaknesses, which gets reflected on the currency exchange rate, right? And it will basically stay within that. I mean, there will be a small space for volatility, few cents up and down, but it will be by and large 4 riyals and whatever, 75 cents or whatever, that will be kind of fixed. But say suppose if there was a huge economic crisis, social crisis, whatever, and suddenly they realize that oil is no longer the valuable energy commodity in the world. They have basically figured out a good alternative to oil. What would happen to the strength of the Saudi economy? What do you think would happen?
It will deteriorate.
The strength will deteriorate. It will become weaker. If the economy gets weaker, how should the currency of that economy reflect? Should it be strengthened or weakened?
That will also be weakened, sir.
That is also will be weakened. So in such situation, if that happens, then they will have to recalibrate this ratio. So in such situations, the two central banks will say, okay, from here on, the exchange rate for the two currencies would be 7 riyals to the dollar or something like that. Now that is an official stance. It's an official announcement, and that is the devaluation. So if that recalibration happens through official means with an announcement, such is a devaluation. If it goes the other way around, if the economy is strengthened versus the counterparts, then your currency will be revalued, right? So this devaluation and revaluation mostly happens when there is a fixed exchange regime and there is a closed economy.
And a small question on this, like this. Now, what is the difference between like for this kind of a situation? I thought it is a currency peg or something. So it is different to this, is it?
No, so fixed exchange rate means a peg.
Okay, right.
See,
Because like
when
I was
said,
working in Qatar, and this the similar kind of situation was there with Qatar Riyal and US dollar. So I thought it was a peg, and this is this I mean this words revaluation and devaluation is quite new for me rather. That's why.
yeah. So that peg is like it's pegged to the dollar. It's fixed to the dollar.
Yes.
That's what the peg is. You know, in a fixed exchange rate regime, how they operate is by pegging your domestic currency to another reference currency,
Yes, yes,
right? So that reference currency is the US dollar. So even in the Saudi Riyal situation, the Saudi Riyal is pegged to the dollar. So you can basically say it's pegged to the dollar, or it's fixed to the dollar as well. Now,
yes,
the real meaning of pegging to the dollar is once it's pegged to the dollar, if the Saudi Riyal needs to trade against euro, then it goes via the pegged currency. So then it will see what is the rate between euro and the US dollar, and then convert to the Saudi Riyal using that pegged currency. Pegged is the US dollar. You understand the difference there? I mean, there is no difference. It's basically a mechanism. That's all.
right, right. Okay, sir. Okay, thank you,
Yeah.
thank you. Yeah, yeah.
So that's what it is. So what you experienced in Qatar, that's where you were, right? Qatar or
Yes,
Kuwait?
yes, yes, yeah.
Yeah. So that is a revaluation or a devaluation, officially done to recalibrate the exchange rate.
Yes,
Okay.
like if the currency was pegged and like while I was there, no revaluation, no devaluation was done. So the peg was consistent,
Static.
right?
Peg was static. Yes.
Yes. Okay. Okay, so thank you. Thank you very much.
All right. So it's pegged. See, one more point that you need to understand is it's pegged to the dollar. So your exchange rate to the dollar is static.
Yes.
But
Yes.
depending on how the pegged currency basically moves against the other currencies, like say for instance, there is volatility between US dollar and the euro, that same volatility will be there when you try to convert your Saudi or Kuwaiti dinar or Qatari riyal or whatever to euro. But with your pegged currency, it will always be that pegged ratio. Because in a fixed exchange rate regime, what happens is you are basically linked to the economy of that pegged currency. So your interest rates need to basically move along with the pegged economy and so on and so forth. So that's where the differences come in.
Yeah, when the Fed rate cuts were there, so entire loan books were the interest rates were changed.
repriced.
Yes.
Yeah, you
repriced.
had to, because you have to basically maintain that interest rate parity for the peg to work.
Yeah.
Otherwise, the peg, but I will show you how that peg works, or at least that interest rate differentials work when we do the swaps.
Okay, so thank you. Sorry for taking your time.
No, that's fine. I mean, it's good. I mean, we can basically, calibrate the discussion also accordingly. It's good that you ask questions.
Okay, so thanks.
Yeah. So let me basically show you I don't know whether this URL will work. Yeah. These are the kind of screens that we are talking about. When we were talking about Reuters and Bloomberg and all, can you see this? I don't know whether. This is a spot trade. I mean, these are screenshots. This is not live numbers, so this would be some historical number also. But this is how it basically gives you. Now, this is.
So we can still see only the slide.
You can't see the. Hold on. Sorry, I may have. Sorry. Now you can see the screen, right? This is a typical Bloomberg screen on FX, and if you basically go through it, it's like a computer. I mean, these are computers, right? And like Excel sheets, but you see these data coming in. Now this is indicative FX trades. These are not trading screens. I will show you a trading screen also. But This is an extraction from a trading screen where they basically give you the current middle rate as it happens. Then you have, the 3-month rate, forward rate, and the spread, the 10-year bond yields and equity indices and all these. Then FX forwards, a huge plethora of information. And then at the bottom, you get basically news flashes coming in, which basically impact the rates instantaneously if it is sensitive to that news item. So the traders need to basically be focused on all these if they are running positions and things like that. I will show you some of those. I mean, we'll go into those discussions as we move. So that's why, forex trading is a very high intense, like bond trading. Financial instrument trading is a very high intense job because, the price changes are instantaneous and it happens every half a second or a millisecond, depending on what news comes out in the world. That's why, these Reuters and Bloombergs, they are not only trading platforms, but they are also information portals. That's why you can basically define Bloomberg and Reuters as news channels as well, in addition to financial trading platforms. Because if you are giving financial information for trading and enabling trading platforms on certain applications, news is a part and parcel of that information data set, because your currency prices, or even for that matter, interest rates, is extremely sensitive to news items. So therefore, traders or people who transact in foreign currency or interest rates need to be provided that information then and there. That's because they make their decisions based on those news items. And not only news items, you have to read the news item and then link it to the currencies that you are trading and see how it basically gets linked. So there is a huge, cause and effect approach for forex traders. And these are all linked through economics. That's why it is also important for traders to learn economics as well. Like, for instance, if there is economic numbers which come out from time to time, I mean, there are certain schedules. The Fed Reserve gives economic news, or there are inflation figures and employment rates and unemployment rates and things like that. So those are key events which traders follow very closely. And the more the transactions are highest, the volatility is highest during these event releases, because immediately traders and analysts would analyze these numbers and come into certain conclusions on what the implications of these numbers would be, and then depending on those implications, they would take certain positions and so on and so forth. So when I say position, sorry, I mean, this is the lingo that I'm using. A position means, like, say, if you want to basically if you are a currency trader, you will want to basically buy and hold certain amount in your portfolio. Say you buy it at 312, thinking that rupee will depreciate and the dollar will appreciate. If that is your view, then you will buy $1 million and keep it for some time until the price moves up, right? And watch out for this information which will impact the price. So that $1 million that he has bought and kept aside is called a position, right? They will position positively or position negatively also. They can basically sell $1 million and create a short position if they feel that the dollar is going to become cheaper in the future, so that you can basically buy your dollars in the future at a cheaper rate and make some money. So this is what forex trading, speculative trading, is all about. and it needs a whole heap of information. Not only information, you need to have the capability or the ability to read and understand the information, decipher the information, uh, analyze the information, and figure out what's going to happen in the economy due to this particular event, right? It could be floods, it could be some social unrest, it could be a war, it could be some macroeconomic numbers which come out. I mean, information is infinite, and traders therefore need to basically focus on the key information which impact their currencies, and that's why they are basically, what should I say? The job is highly intense. It's highly stressful, and it needs a certain skill set also in you, because sometimes you take a position and you take a you let's say you buy dollars expecting the dollar to strengthen, and suddenly something happens in the world which you have absolutely no control on, and the dollar will crash. So in such situation, we need to basically understand, is it crashing because of this single event? How long will this event last? Will it basically bounce back or turn around and become strengthened back again? Or should I cut my losses now? Right? So traders have to be disciplined. They have to be able to, hold on to losses for some time without, panicking, and so on and so forth. So it needs a certain kind of caliber of people. Not everybody can basically stomach that stress and pressure. So that's why sometimes they are kind of paid differently, they are remunerated differently, and so on and so forth. Right? Just I'm promoting some of my junior blokes jobs. Yeah. Okay. So then going back. So these are, let me see whether there are trading screens also. In this article, I can't find a trading screen, but then see, we have various functions, charts, through which you basically look at price volatility, and you analyze price volatility, yeah, and take certain decisions based on the charts, how the currencies behave, and so on and so forth. This is highly technical, not expected of you to know all these things, but I'm just for whoever who's interested, you can basically go to some of these links, read them, and it gives you a lot of insight. Can you see this, how Euro USD has basically been volatile during a period, 1 year period? It could be, you can have, you can run charts for annual charts, you can run daily charts, you can run hourly charts, and look at how the volatilities are. It's quite intense, and sometimes it's fascinating also. So this is how, can you see this euro dollar chart?
We can, sir.
Yeah. So you see how it has basically crashed. This is a period of 2014 to 2015, how it has crashed. It'll be interesting to understand what this event was. I think this was when US dollar, US started reversing the interest rates. Yeah. See, in 2014, I think after the prolonged low interest regime, they first started increasing interest rates. And then euro crashed against the dollar. Dollar started strengthening because the US, holding interest rates at near zero levels, started picking up. I think this was that event. And then thereafter, this is how it went. Yeah. What else? Yeah, so you can go into any of these URLs and read for yourselves. It will be interesting to understand some of these things. So exchange rates. Again, I mean, this is, I think, self-understood. Like say exchange rates, you have an understanding as to how exchange rates would impact prices of one country against the other, right? I don't have to explain those things, do you? If you basically read through this example, it will basically show you how it costs one at one country, another price at in a different country, right? So because it basically strengthens or weakens or impacts the price levels of in certain countries. Like say, for instance, let's take the most commonly watched commodity price, which is oil price. Now, if oil is at $100 a barrel, I mean, I'm not just taking a very casual approach to this. So $100 a barrel, which means uh, uh, in Sri Lanka, it should be 30,000 something, right? 31,200 or whatever, 312. Then you basically refine and do all kinds of stuff and arrive at a certain per liter price for petrol. Now, if the international price remains at $100, but currency basically weakens to 400, then what would happen? Your oil barrel priced in Sri Lanka rupees would be 40,000. And therefore, your liter of petrol will go up by that amount, right? But if the currency basically appreciates to 250, your oil barrel will be $25,000, 25,000 rupees, and your liter of petrol will reduce in price by that amount. So that's the implication of forex movement in imported goods, right? That's simple. But it basically has an opposing impact on your exports. Yeah, same impact, but in the reverse. So therefore, when in economies, we need to basically, especially economies which are basically trying to develop their, export base and things like that. Sometimes you can't expect this free market price determination to happen. So that's why we say in countries like ours, whom are trying to break through and develop into more vibrant economies, would want to basically have a certain regime that supports our economic agenda. The unfortunate thing is we don't have an economic agenda, or our economic agenda is not in line with the expectation of the country, right? So we want to basically have a very import vibrant economy because we want to show that this country is very rich and imported goods are there, and that's the fashion, and people are very happy when they see imported goods and they go and vote the party who bring in all these imported stuff into the country. How it comes is of no consequence to or concern to the voter base, right? So therefore the governments then will try to basically borrow money from overseas and use those borrowed funds to import goods and flood the markets with import. Now, this is something that happened not so long ago, right? But however, in the same context, if you want to basically keep the oil prices low, sometimes these people will basically appreciate the rupee artificially and keep it at a particular level, right? Or if they want to basically, if they have huge outlays of, loan payments, then it will be, beneficial to these guys to balance the budget to keep the exchange rate at a particular level, but which is completely detrimental to the aspirations of the economic, the people would want basically, or, country would, let's say, the only path we have is basically, I mean, we have realized it. And if somebody has not realized it by now, I think they should be shot. I mean, colloquially, not literally. But the thing is, I mean, there is no other path other than basically generating dollars in this signal. I mean, we have to have a strategy to generate dollars. So how do we generate dollars? Either through exports or, bring in FDIs forever and ever, amen, or bring in FDIs now, dollars come in, get the FDIs to generate exports, and then sustain those export proceeds. Or go into the service industry like tourism or IT or whatever, and then use those. So we need to generate dollars. That's the bottom line. So in such situation, it's also favorable for us to have a slightly a weaker currency. But the people need to also be satisfied, given these, because oil itself will have an impact on inflation and things like that. So therefore, we can't just depreciate the currency as and when we want or let it depreciate. So there has to be therefore some control to create a balance in between, right? So that's where governments would intervene to make that balance in the currency exchange rate, right? So one cannot blame a government if that government comes in to intervene, but the point that we as economists, general public, need to be aware of is, are they intervening with the right intention, right? Which is not going to be detrimental to the overall economy. If they are intervening in the foreign exchange market, which is adverse to the overall economy, then we have a problem. Okay. So the exchange rate is also a clear source of imported inflation. That is through that weakening of the currency makes imported goods more expensive and therefore increases in prices and imports inflation into a country, including oil. When oil comes in, it's an intermediary good. And if that is expensive, then everything that uses oil also will go up, like transportation and all that. And as a result, there will be a general increase in price levels in a country. So therefore, we have to make sure that the currency impact or exchange rate impact on this import inflation is contained to manageable levels, right? That's one of the reasons why countries would intervene in the forex market to maintain that balance. These things you can read and understand, this law of one price, which basically gives you a sense of how this exchange rate is determined through law of one price or theory of purchasing power parity. These things are very similar. Both these things are very similar. And I don't have to go in a lot of detail. I think you have learned this in your basic degree programs as well, right? So this is the starting point. Some theories of exchange rate. What it basically like, even both in a way say, if all these other factors are not impacted, prices for identical goods in one country should basically reflect a similar price structure in the other country. And then see what I was talking about, the haircut thing. So the price differential, if there is a price difference, that's the difference in exchange rate of the unit of the currency of the two countries. That's what it means. And theory of purchasing power parity is, if the prices change in two countries, the exchange rates change to reflect that parity. Right? So it's one and the same, but one is a little an extension of the other. Right? So that's the starting point, and then thereafter the economic factors, the other cost factors, and all these things, trade barriers, and all these things come into play, and then gives rise to a different level of exchange rate. But the starting point is law of one price and theory of purchasing power parity. Right? I mean, everybody can read these examples and understand them. If you don't understand, let me know. I will basically take you through this next week. We are meeting physical, I think, right? So this is why I say it's the starting point, and these theories can't basically explain the exchange rate movements beyond a certain point. And those differences are that, even a haircut in Sri Lanka versus a haircut in New Zealand would be not identical. And they are not tradable goods also, one thing, right? And similarly, an apple in Sri Lanka would be different to the quality of the apple in New Zealand, for instance, or US or England or wherever. So therefore, those differences basically contribute towards disruption of this purchasing power parity, right? And then, there are trade barriers. I mean, traded goods are not, exchanged from barriers freely between countries freely. There are certain tariffs and quotas and tariffs and duties and things like that. So that also impacts this relative prices between two countries, right? Then the cost structures vary, individual tastes differ, and depending on that, the demand and supply for goods and services will differ, and depending on those, your import demand, export demand changes, and it contributes towards rate changes, right? We'll basically I need about 5 minutes or 10 minutes to explain this, but let me basically take you through this whole thing tomorrow, next week. I will conclude this and then we'll go to the next session, lecture, 7 slides next time. Okay, I think we are almost there. Yeah, 4:58. Yeah, so in the law of one price, just to, since we have a little bit of time, let me explain this. Like, we have basically taken identical good, because otherwise you can't explain the law of one price. So let's take steel. Steel in America and steel in Japan are considered identical. So American steel costs $100, whereas in Japan the same steel costs 10,000 yen, right? So if the law of one price to hold, the exchange rate between yen and dollar must be 100 yen to the dollar, right? So that 1 ton of American steel sells for 10,000 yen in Japan, and 1 ton of Japanese steel sells for $100 in US dollar, United States. You understand that? So one is $100, the other one is 10,000 yen in the other country. And if exchange rate remains at 100 yen to the dollar, when you bring in steel from Japan to America, it costs you $100 in Japan, in America as well, because 10,000 divided by 100 is $100. Similarly, if you take American steel to Japan, then $100 steel multiplied by 100 to convert to yen becomes 10,000 yen in Japan. But if the exchange rate changes, right? Let's say 200 yen to the dollar, then what will happen is the Japanese steel would become how much in US? 10,000 yen divided by 200 would become $50 in America. Similarly, American steel, which is $100, will now be 20,000 yen in Japan, right? So what happens therefore is American steel will be more expensive in both countries, because Japanese steel will be $50 in America, whereas American steel is $100. Then in Japan, Japanese steel will be 10,000 yen, and American steel will be 20,000 yen in Japan. So then there will be certain price adjustments that will happen to bring the exchange rate to 100, so that the demand for Japanese steel and US steel will become equal. So this is the theory. It doesn't happen in practice, because there are various other barriers that are there. Steel won't basically go from one to the other just flying on its own, kind of thing. So they have to be shipped, and there are certain trade barriers of entry, then certain costs of transportation, and so on and so forth. So the theoretical aspect is this. So the prices need to change, and law of one price need to remain for exchange rates to remain static. So that's the law of one price. Then purchasing power parity is also an extension of that, which basically talks of exchange rates will basically adjust between two countries to reflect the general price levels of the two countries. So it's kind of a reverse, but it's linked to the law of one price. So one is the price levels changing to adjust the exchange rate. The other one talks of the exchange rate changing to accommodate the price, relative price changes, right? So just read through this. This is the starting point for exchange rates, and then thereafter there are various factors that basically impact. Long run, there are certain factors. Short run, there are certain factors which impact exchange rates. And that's what we will discuss next time. And we'll go on to the next lecture, next series, or next set of slides also at the same time. All right, so we'll stop here.
Thank you, sir.
Thank you, sir.
Okay, thank you, sir.